invest in the real estate. So when we talk of syndicates, this is basically, I'm not sure, from your screen, is it recording? It's recording.
Yes.
Wonderful. So I'm saying that a syndicate is a group of interested parties or investors who will come together with an intention of raising the required capital or equity to acquire, develop, manage, or operate and sell a real estate. That is basically what syndications are for. So the people involved, we call them the syndicators, and they'll be looking into financing, which of course offers the small investors the opportunity to invest in ventures that would otherwise be so hard or that was beyond their financial capability to invest in. So many syndications are in the business of acquiring, managing, and then they sell the real estate projects that they had acquired. So in order to acquire a property, they will bring in the investors with capital. And this capital will form the equity base with which the property will be acquired. So we can easily say that syndicators do not usually invest much of their own capital. Rather, they are agents or they are managers. So they'll be dwelling on earning fees because of the acquisition of the particular real property, managing and selling the property that is owned by different investors. You see the syndicator here is in the business of acquisition, managing, and of course selling at a higher cost than the acquisition cost to get now the profit for both them and the other investors. We have developers equally who need additional capital. This developer can come together or they can seek this capital from other interested firms who specializes in raising capitals, or what we call the venture capitalists or the angel investors. There are people who have old monies and they are waiting for someone to attract them with a business deal and they'll be ready to go. So the syndication may become involved during the development and the construction of the project, but after building is completed and leased, that's the end. Well, so the developer also typically receive a development fee. So it could be a strategy to allow the developer to focus on the developing the project and earning the development fee. So whatever is retained is now what goes now to the owners of the particular project. So in cases where a smaller number of projects are to be syndicated, investors will go for the limited partnerships. So I'm talking of the smaller number of projects. But for those which are huge and requires a lot of capitation, they'll ultimately go for big corporations because of the limited liability. So the particular project or the properties to be acquired may or may not be identified when the funds are being raised. Though there are those investors who will go for only investments. When you come in, kindly mute yourself, especially if you are late. You cannot be late and then you join in and start making noise. This is a class. For the few sessions you've had, you are supposed to have noted that. So we go on. I was saying it's not necessary that the particular property will have been identified by the time we are approaching the venture capitalist or the investors whom we are, the investors whom we are wooing to come on board. Of course, many of the investors will be interested in what we call the blue chip or the trophy properties, because the target for acquisition is we are acquiring to resell. And if you are acquiring to resell, you cannot just do that from a blind pool. You have to identify and say, this is the particular property that, or this is the area. And I said real estate got two markets. We have the hot and we have the cold. So once you identify that it's on a hot area, you'll go ahead now and let the investors pull in the investment. And they'll come in different equity ownership. There are those who are going to contribute more or large amounts, and there are those who are going to give less. So when we are talking of a blind pool, this is where the syndicator is having the discretion of purchasing the property wherever they want. So I've said we have two categories. There are those investors who will be wooed if it is a blue chip or a trophy property, a property that they know this one is a sure bet. If we invest or we take our equity here, ultimately we are going to make something from it. But for the blind pool, the syndicator has the discretion. They get the money, put it in one pool, then go ahead and look for the property that they are willing to invest in. And this is where most of the MFIs or the syndicates I was telling you about that are started by bishops and churches or other unscrupulous investors, they'll just ask people to start commingling their funds. They can even start with a capitation of only 5,000. Wewe leta your 5,000, mwingine alete 5,000. So share moja inasetiwa, let's say at 5,000. So if my pocket allows to acquire 3 shares, I'll be giving 15,000 every month. Then they commingle the funds. After a period, of course, they are still recruiting more investors into the pool. You don't know what you are buying. You are just commingling your funds, which is not the best approach if you are an investor. You should be knowing, I'm doing this because at the end of the day, I'm looking into investing in this or that property. For the blind pool, you are not aware. So you continue commingling your funds. Then at some point, the syndicator or the promoter of the idea will come on board and say, we have identified some 300 acres of land in Kamulu. So we will go there, do the mutation of the land, and then share to the people who are giving out their contributions. That will not be termed as a syndicate. If anything, that's a pyramid scheme where you are trying to commingle the funds, and then after you get now the capital or the amount that you intended to swindle people, you go ahead and invest. So we'll be very particular when we are talking of the syndicates. We are talking of a group of people or a group of corporation or a group of investors who have come together. And the reason of coming together, I said it's because they want to have a tax through. If you go as a syndicate, there are those tax advantages that you are going to enjoy as opposed to if you are to go as a corporation. Someone might ask, if I'm already a large corporation, why should I be interested in performing a syndication? If I have the financial muscle, why should I go for a syndication? We are establishing this syndication because of the tax-through advantage that we'll be enjoying. So we'll be looking into the different forms of the syndications, but we'll see that most of them, of course, we expect that in the syndication, you are going to have a contractual agreement that is binding now the syndicator or the person we are calling the manager, the investor manager, and the investors. Kubende. Kubende, how are you?
I'm fine. Sorry, sir.
I'll think what I'll do in the subsequent sessions. I'll just need to change my Zoom settings where I'll deny you all the rights. You don't have a right to talk. You don't have a right to put your video or your mic on. I think that will ease my time here. So in the subsequent classes, I'll be setting you on mute. You will be purposely there to listen. You cannot interject. You cannot talk. You cannot chat. I don't know whether this is the right way that you want us to be approaching this class. Kibibi. Bakari. You see, someone is on a point of notice. When I ask them what they are saying, they mute. They have already interrupted the class. Anyhow, let's go on. So I was saying, in establishing now the syndication, the investor or the manager, the syndicator, let us call this person the syndicator. Whoever is promoting the idea of forming now the syndication is called a syndicator. He'll be looking into options that are taking advantage of the tax situation. So this person will be looking into two aspects. One, general partnership, and two, limited partnership. And you recall when we were talking of now the general partners and the limited partners, a general partner will come because they have unlimited liability. And they are bringing in their profession in the real estate. So most of the things, they need not even contribute in the capital. But what they are bringing in is the professional aspect. They understand this area, they are in this space of real estate, so they'll be providing the advisory. They are like consultants. So a syndicator will be having a lot of knowledge in the real estate properties that have been vouched outside there in the market. So they are looking for a venture capitalist who has the capital and they are willing to invest that capital. But the other key thing of forming the syndications is trying to get the tax-through advantages. Someone will ask me, then why should we have limited partnership performing the syndications? They'll do this because they are going to enjoy the tax advantage. If they went as partnerships only, just general partners, they are an association. And an association is just a business name. So these people will still be taxable as normal. So the objective will not just be carrying out the business of real estate. The objective is to ensure that you are getting the best of the information through the syndicator because they are professionals. They'll help you manage. And by management, I mean, if we are acquiring or if the acquisition is on land, and then from the land, we seek a developer. And this is the formation that most approaches, that most syndications are taking. They commingle the funds or they get the funds from the investors. These funds, they identify a place or a parcel of land where they are going to develop the property. Then from there, they go ahead and lease or they go ahead and sell the property. That's the rationale. So we are looking into centralization of the management to some key person whom we are calling a syndicator because they have the know-how or the information. If you follow keenly on the Partnership Act, the state is very clear on how the partners are supposed to commingle. Because partners are the easiest opportunity or are the easiest window or loophole for tax evasion. So the criteria of the limited liability might be negated by the fact that one partner is general and the other one has unlimited liability. So we should also look into the free transferability of interest, such that we don't render one party at a disadvantage. And this is what has been happening to the land buying firms that you see around. They get funds from customers. They tell them that they are financing on development. So you just give out your money. You don't even know the land. I was listening to someone complaining in the TV, saying how they gave out their 300,000 deposit. The date, you know, these land buying companies will tell you the land is somewhere in Thika Road. The Thika Road corridor runs the way from Pangani, where we have the Jubilee House, all the way to before you terminate to Thika Town. So if you are told that your property is lying somewhere on Thika Road, it could be in Pangani, it could be somewhere in Juja, it could be in Thika Town. It's good to be specific. Don't just go for the blind pool. Before you give your money, then she was saying that they took like 2 hours before identifying where the parcel of land was. Even the sales agent who was promoting this particular syndicator didn't know where the property is. They took like 2 hours. So you can imagine 2 hours. 2 hours is a journey from Nairobi to Nakuru. So if it takes you 2 hours kutafuta shamba na ujui mahali iko, when the investors have already given their money, it shows that you are not serious. So the government has been very keen on the syndications. Whereas the government is trying to promote the issue of the affordable houses in the Big Four agenda. But again, it cannot be used as a loophole to swindle Kenyans their hard-earned cash. So kindly note that the reason why the syndications are being formed is generally to make use of the consultancy of the syndicator, because they have this information and they understand so well the dynamics of the real estate, the macroeconomic determinants of the supply of houses, where and when they are needed. The other challenge will be, I was telling you the other day, you could be having this money that you are talking of from the venture capitalists or the angel investors. You have the capital, yes, you lack the knowledge, or you don't have the information. Now, information is the potential power for you to invest in the real estate. So if you go and invest, let's say, in a property in Kitui, let's say you go and build a so nice house, apartments. Let's say you even use like, let's say, 500 million. So that is 500 million. Well, we say that real estates are the best. Yeah, they'll never go old as long as you are renovating them. But as an investor, are you getting the value for your investment? Chances are you will get a few tenants who will be interested because the house is new, but your vacancy rate will always be higher. So we say a good investment property or real estate property is supposed to have a vacancy rate of only 5%. To simplify this, if I have 100 rooms, at no time should I have more than 5 vacant rooms. If they are more than 5, I'm not in any business. So real estate financial analyst provides for only 5% vacancy rate. So the purpose of syndications is making sure that there is optimum return on the property or the investment that we engage ourselves in. So we'll go on. I think that is enough. That is enough details on why. So these are the vehicles or the investment vehicles that the syndicator may try and onboard. So they may use limited partnership in either private or public sector. And we look at them one by one. starting with the public, or we start with, yeah, we can start with either, it's okay. So when we are talking of the limited partnerships, this has been used for long as a vehicle, of course, to venture or to bring forth the syndicates. And there's a story there of real estate finance, of United States of America on matters of the tax reform, etc. You can ignore this. You want to engage in our soil. When we keep on, unless we are, well, you can ignore it, this information here. We'll be coming to the real estate investment trust thereon, so it shouldn't worry you. So when you are talking of the private syndication, the venture is to be undertaken and the relevant costs and the financial data taken. And by private syndication, we mean we could be having the general partner, and we have now the general partner or the syndicator, and we have the few, and I have a case that I want to illustrate here, and we have the few individuals that have expressed interest in investing. Now, the purpose here is to understand the framework, to be able to analyze how this product will be partaken as a private syndicate. And I want to present the case of Dalak. We have a case here which will help us, of course, understand. Now, we have a venture here that has been undertaken by a syndicator in the name of Dalak. And what has happened, Dalak, I'm trying to look at the case. Well, it's here. Now, when a syndication with other investors is undertaken, it's essential for the parties to understand why they are coming together. And I said they could come together to purchase a bare land or a virgin land, a land that hasn't been developed yet. So they'll come together, purchase the open parcel, go ahead and look for a developer who will be paid for developing and leaving now the property for investment. So that is one model. The next model will be where we buy an already complete property. So we are buying, so the purpose of the syndication will be using the information that is with the syndicator to help manage and run the acquired property. And there are those people who will acquire to sell. So you are acquiring either a bare land, you develop, and then you manage. Or you acquire an already complete, you develop, not develop, you acquire an already complete, you invest in, to say that is a rental property or a lease, depending on the agreement of tenancy. Could be a lease if it is more than 1 year. If it's month to month, then we'll be talking of rental income. Or buy and sell. So you have those three models: buy and develop, and invest in. Or buy already developed and invest in for generating the rental income or the lease income, or buy to sell. So we have this kind of syndicate. We have an analysis of a private real estate syndication that acquire and operate an office apartment in the name of Plaza. So in this syndication, we have 35 individuals who've been approached by Dalak Investment Corporation, which has agreed to act as the sole general partner. In other words, this is the syndicator. So Dalak is trying to raise sufficient equity for the company or Dalak Corporation, Investment Corporation, to be able to acquire and run as a partnership. So the venture to be undertaken and the relevant cost is summarized in the data that we've been given below. And this is the data. To bring the data. So you have the data here. So you can see we are buying Plaza Coffee Building. So the cost breakdown is as listed. The land went for 525 million. There were some improvements, and improvements, they could be capital in nature. We talk of the capitalized improvement if they involved structural adjustments. If you go in town, you'll find that most houses are built floor to floor. A bare floor looks like a hall. Then whoever now wants to manage that particular floor, they'll come and now do the partitioning. So the partitioning is what we are calling capitalized because it is changing now the structure of the building. Then we have the points. Now in our non-current assets, we normally talk of goodwill. When we come to the real estate commodities, we talk of the amortization because most of these properties, they are on mortgage, and mortgages can only be amortized because the financier has only given you the rights or some minimum privilege to own that house as you are paying for it. So you cannot account for the goodwill. Then we have the organization fee, or this is what the interested parties are supposed to pay, and it is been spread for 5 years. So you can see this like the goodwill that you've been able to acquire for the period that we've been in operation. Then we have the expenses, and this one, they are capitalized but not depreciated. To mean an analysis further will be done and you will be seen in the subsequent exhibits. So in total, we have the value of the property is 4.18 billion. That is the value of the property. We acquire it through a loan or a mortgage of 3 billion. So this is funding of that 1.77. So you can see whatever has been funded as equity from the investors is to a tune of 28.33. So the property is by and large financed through a mortgage at an interest rate of 12% per annum for a period of 25 years. Mortgages normally are long-term lending. Then the cumulative points estimated to be 60,000. So the annual debt service is 379,161. All that is the mortgage that is repayable every year. And this is what will be paid until the end of the period. So this is how the syndication is operating. DALAC, or the organization acquired DALAC, the organization acquired the Coffee Plaza on December, and that is our year one. So the number of partners, we have DALAC, who is the general partner, and then we have the 35 limited partners or venture capitalists that have shown interest. The equity capital contribution, the general partner is giving 5%, limited partners are giving 95%. There is no cash assessments, to mean there was no valuation involved at the onset, so we don't have any recurrent cost. So cash distribution from operations, general partner gives 5, limited partners 95%. Then taxable income and losses from operation, the general partner will take or plow back 5%, limited partner will take 95%. Now the allocation of gain or loss from the sale, general partner will take 10, limited partner will take 90. If you recall, when you are talking of the general partnership, we said that equity ownership could be okay. It's not necessarily that it's equal to the sharing of the gains or losses. You can see by equity, the syndicator is getting 5% as equity in the business, and the others are getting 95. But when it comes now to sharing the gains or the losses, the syndicator is getting 10% out of the total income, whereas the partners are taking away 90%. And this one will now be formed in the, when they are doing the contractual agreement. Could be the 5% that he's charging is the professional or the consultancy fee. Remember, you said that the syndicator is coming on board because they have knowledge. The other limited partners are just giving out their capital. And then Dalak will run the show because he's the person who is knowledgeable. So we can see cash distribution at sale is based on the capital account balances. Now this will be explained, but you can see the initial equity requirements. Our total is 4.18 billion, less the mortgage financing, which is 3 million. So the equity that is required to come from the 35 investors is 1.18 billion. 3 billion has already been acquired through a mortgage. So the general partner out of this will give 59 millions, whereas we are getting 1.21 billion from the 95 investors. Are we together so far? Now the challenge with the the challenge with the syndication is that it does not consider the effect of borrowing of money. And we know that in debt financing, in many cases, the investor, of course, will pay for the property through the interest that will be charged. But you can see here, we are just taking the absolute value of the mortgage. Whereas above there, we've been told that the repayment, if you compound this for 25 years, you'll find that whatever the amount that is being paid, if you take the interest rate for 25 years. Did I show you how to amortize? Did I? Did I show this class how to use the amortization calculator?
No.
If you are using a laptop, let me see. Let me just share. Just open any blank Excel. I want to share a screen of a blank Excel. I have a blank Excel. Let me open one. Just open an Excel sheet. Have you opened one? Let me share mine for the purposes of. Am I sharing? Are you using a stop sharing? You're able now to see an Excel sheet.
Yes.
Now you go down here where it's indicated sheet 1. We'll be making use of this. That's why I want you to know how to amortize the mortgages. Are you seeing sheet 1? Right click sheet 1. If you right click, it will give you options. You go to insert. So you click insert, and in the insert, we have two options on the toolbar. We have general and we have the spreadsheet solutions. Are we together so far? So choose the spreadsheet solution. Once you choose the spreadsheet solutions, we have what we are calling here loan amortization. So I want us to work on the loan amortization sheet. I want to confirm that everyone is there. Are we there? Are we able to go there? Do you have any challenges?
Actually, sir,
Mm-hmm.
most of us are using phones. So I think those ones who are maybe with laptop should speak, or if anyone is not with laptop, you should just show us, then anytime later we can use them.
It's okay. So you said that the loan is 3 million. So you will indicate there, ignore the dollar sign, just assume these are Kenyan shillings. So the computer is made by HP, which is a US company. So we go now to the annual rate. We've been told is 12. The period of the loan is 25 years. The number of payment, we assume they are paying every month. So 12 payment per year. Today is 30th. Let's say we take the loan today and we'll be paying our first installment in October. So October 30th, 2020. So I've spread and there is no any early repayment. So this is Dalak investment. So the customer is Dalak. So if you look at the dashboard, this is now the mortgage that Dalak is getting from the bank. The mortgage has been spread for 25 years at an interest of 12% per annum. So if you look at the right-hand side on the loan summary, you can see the scheduled payments. So you have the scheduled payments are 300, and you can see every month they are paying 31,596. So as at the end of the period, the interest that they'll have paid is this, 6.4 billion. What was the value of the mortgage? 3 billion. You can see it's like the mortgage has tripled, because the total principal now plus the loan will be 9.4 billion. And these are the dangers of riding on a mortgage. So you could think that you are making the initial payments here. You see, the bank, of course, the mortgager will give you the repayment, the year standard. But being an accounting student, you are supposed to know is a reducing balance. So by reducing balance, we mean initially you can see what we are paying. Out of the 31,596, we are paying an interest of 30,000 and the principal is only 1.5. So you can imagine what is happening. Initially, you are paying a lot of interest. Because it is on reducing balance, I want to elaborate. You can see our interest. If you look at the interest column, it is reducing. So the interest is reducing as the principal is rising. So the few, mute yourself. So you can see what's happening towards the end of the mortgage, the interest has drastically reduced. It is 312 shillings. When you are starting, the interest was almost 30. Veronica, I have a problem, Veronica, with you. And this is the second time.
Yenyewe inaja mute. Ni yenyewe si mimi.
No, it cannot unmute. You see, Wabure, we are 23 of us in this class. You cannot take advantage of 22 learners or 22 participants and tell them at unmute. That cannot happen, Veronica. I'd rather you'd have said you have unmuted mistakenly, but you cannot say that it's unmuting itself. How can it unmute itself? So we look at I'm looking at the principal. So you can see what is happening toward the end of the mortgage. The principal is now increasing. That's why we call it reducing balance. As the balance reduces, interest goes up, interest goes down. So initially, because the mortgage is so risky, the bank is charging you a lot of interest. But this interest will be declining. That's why we call it reducing balance. So as the balance reduces, the interest is also going down and the principal is going up. That's what I needed now to illustrate. So I was saying, so you can imagine DALAC has not taken into consideration all this total interest. Yet, we know that the value of the property is, by and large, actually 71.77% is on mortgage. And this mortgage, you are supposed to pay interest over and above the amount that you acquired. This is one of the challenges that we have when we are looking at the debt financing, especially in the real estate. Because the venture capitalist is not interested. The venture capitalist or the person who is bringing in their money, they are interested in the venture. You told us that it is going for 4.18. We have given you 1.121 billion. You have come in and you have given your stake. We go. So the how you are going to meet your interest and the like is on your own. So it becomes really challenging to the syndicator if they don't know how the real estate properties operate. And that's why we are using a professional. We don't want to care how the mortgage will be repaid. All that we know is that we are getting into a profitable venture. So the how he manages the mortgage to ensure that we don't lose is on his side. So I needed you to understand that. So you can even go, before you take any even loan, it's good you do a self-analysis. So suppose DALAC was to invest this money instead of paying back the mortgage, he would have acquired 2 equivalent properties and he wouldn't go to venture capital. But again, he's an investor. So I want to stop sharing. So you've seen the screen. And I go back now to the example. So we are back. So that is how we amortize the facilities. So here we are. I want to expand this. So we go back. We are here. So I've indicated that these allocations affect the rate of return to each of the partners. And they are therefore paramount in the considerations of the analysis of ownership. So when special allocations are used to allocate items of income and cash flow in different proportions to different partners, it's also very important to know how to determine the amount of cash that they are going to distribute or get on the sale of the property. This final cash distribution is to be taken into consideration at the onset. Remember, we are using a principle of IRR. In the previous class, someone was asking. If you recall, when we talk of IRR, it is the rate that makes the present value of the projected cash flow equal to the initial investment. So if you know that there will be different proportions, to avoid now having a problem when we are doing the distribution of the profits or the losses, it's good that this be mentioned at the onset. Later on, we'll be coming to the calculations, but we write on three items when we come to real estate. We have what we call the effective gross income. An effective gross income is basically the rent minus the vacancies. That is the effective gross income. But we have the other expenses that we incur. Like we need to be paying for the garbage collection, we are paying for lighting, heating, waters, etc. So we'll need to subtract all the expenses that are not capital in nature to get the net operating income. So these three are very key: the IRR, the effective gross income, and the net operating income, because it is these three figures that will guide the proportionate share once we sell or when we want to share our profits. So given our analysis of DALAC, you should have a general framework in mind to consider potential investment involving limited partnerships. So the stress should be on DALAC case because it is meant to illustrate the possible way in which an investment can be structured. So we had the general partner who is taking 5%. We have the limited partners who are chunking the bigger share, which is 95%. Only to be told that the 70, only to be told that the 71.77 is coming from debt financing. And this debt financing, imagine, is not into consideration. So all this information should be put into perspective when you are coming up with the IRR figure, because it is this figure that will help the investor be attracted into the property. We'll be coming into the deeper details of that later on. So partnership allocation and substantial economic effect. So when we are talking of the partnership allocation and the economic effect, this is where now the drawback comes in, because this is where now the venture capitalists need to be told that after we raise the required equity for the real estate, we are going now to share the loot in a manner that will ensure that everyone has profiteered. So the Uniform Partnership Act dictates, or there are canons that you are not supposed to take advantage of anyone's equity and not give them we call it affordable loss. Affordable loss is, I gave you this money. I didn't know, you see, it's the risk we were taking. So my affordable loss was 1.121 billion. You are not supposed to take the advantage of the affordable loss and say that we indeed incurred a loss and therefore we'll just give you back your equity. So we should understand that the reason why you are coming together, the advantage of the partnership, one of them was the few individuals, was the ability to allocate the profit or the loss to the different individuals as it comes by. I want to show you another very ironic perspective of the drawbacks that we may get in the syndications. Now I have a case here. These are capital accounts. Now assume A and B form a partnership where A is the limited partner who contributes 100,000 and B is the general partner who contributes nothing. So they are bringing in their consultancy, or they are bringing in their knowledge. Now the partnership secures a 400,000 10% interest only non-recourse loan and acquires AB apartment for 500,000. So assume that the results from the first year of operations is as follows. So we have the first year here after the agreement or after partnering into this syndicate. So the gross income is 70,000. So this is the EGI, the expected gross income. Then we subtract the vacancy and the collection loss. Of course, the fees that we are going to forfeit, it's 4,000. So our effective gross income is 66. Then we less our operating expenses, which are 21. So our NOI, our net operating income is 45,000. So we less the amount that was used to service the debt. We know that the debt was 400,000 and it was 10% interest only. So 10% of 400,000 is 40,000. So before tax, our cash flow is 5 million. That figure is in millions. So assume the tax depreciation in the first year is 50,000. Let us assume that is the tax. We have so many categories of tax in real estate. So let us assume that the tax depreciation for the first year is 50,000. So the results will be as follows. So I should have taken it into, let me just take it into one page to have a better view of what is happening. So this is the view. So assume that our tax depreciation for the first year for AB apartment was 50,000. So the results in taxable income will be as follows. So you can see our net operating income, it is 45. It is up here, this figure. That is our net operating income. So you take it down here. Once we less the depreciation, which is 50,000, now for the tax for that particular year, then we less the interest on the loan or the mortgage that we are servicing, you can see we have a taxable income of negative 45,000. So we are already at a loss. That is first year only. So now assume that the partnership agreement provided that 90% of all the taxable income or loss and cash flow from the operation was to be allocated to A, 10%, and B takes 90%. So at the end of the year, this is what we expect to, just a hypothetical illustration. This is what will happen. So initial capital contribution, A had given 100, B had given nothing. They are bringing their knowledge. So we less now the allocation. This will now get the 90 and this is getting the 10%. So you can see the cash flow distribution, right? It was 5,000. What we got here, go back a bit. So you can see before tax, our EBIT is 5,000, right? So if we distribute that, this is what will happen. You are going to have 4, 5, this is 90%, and then 5, which is 10%. So the ending balance, as at the end, our capital accounts will be reflecting something of the sort. A is giving 55, B is giving 5. So I want you to appreciate how we can be affected by the tax. That's why I said syndications are coming into being to try and have the tax pass through. Now let us assume further that we sell AB apartment after this same year. So this will be the results after we sell. Let me take them into one page. So this is after the sale of AB apartment. Our selling price is 550 millions. The purchase price then will be 550. We are assuming that the selling price and the purchase price are one. This is the prevailing market price. It has not changed. So the depreciation is 50, but we are going to adjust that when we go now to the capital. We was assumed that the adjustments have been made. In the initial cases, we had not adjusted our accounts, but after the adjustments, we are able to remain with 450,000. This is the adjusted figure. So our gain is 100,000. So this cash proceed from the sale is shared as follows. Or before the share, our selling price is 550, we less the mortgage. So you see the mortgage is 400,000. The interest is not considered. And I say this is a challenge in now debt financing when it comes now to the syndications. So our cash flow as at the selling point will be 150. Now suppose that upon resale, taxable gain or losses are to be split at 50-50 between A and B. I want you to look at the statement that is indicated there. So cash proceeds will be distributed first to A in the amount equal to his original investment, less any cash distribution previously received. Now the any remaining cash proceeds will be split on the capital accounts of A and B. Are we there? So we are going first to less the cash distribution. And we know that B gave nothing. A gave 100 million, right? So the table shows the impact that this arrangement would have on the capital accounts of A and B. So the net balance of the two capital accounts is 0. That's our assumption, right? But A's capital account is negative because of the tax aspect, right? And B is positive. I'm waiting for your absorption. I was explaining the issue of the substantial economic effect. So we go on. So as mentioned, for an allocation to have a substantial economic effect, liquidation proceeds to be distributed must reflect the disparities in the partner's capital account. So where A's capital account is negative, B is positive. So A has in effect required his investment at the expense of B. So he may not have done the entire economic burden equivalent to his share of the depreciation deduction, and the allocation lacks substantial economic effect. Therefore, in order for the allocation to be recognized, the capital account of the partners must be equalized before the partners in this example splits it into 50-50. So I'm taking you back now to the IRR. And that's why I'm saying that it needs to be documented in the partnership agreement. And this is one of the problems of the syndications. You've seen many groups or land buying companies, they do so well. An example is Suraya, that is owned by Susan and Moraya. They bought a lot of properties along Kiambu Road. others in wastelands, others in parklands. They were constructing some other upcoming apartments in Kitengela. But at some point, they collapsed. That's the challenge of syndications. If from the onset, the IRR was not anticipated, and we said that IRR operates on the principle that the present value of the projected cash flow equals to the initial investment. If that is not taken into consideration, then the venture capitalist will be taken advantage of. And you've seen people losing all their money in the syndicates. Are we together? Or these are becoming elephants? Tuko pamoja? Class, are we together?
Yes.
Nicholas, are you getting something? Can you explain to us, like 2-year-old babies, how the concept of syndicates operates? Nicholas, what is your take home? Of course, anyone that I pick should have a take home. Jacqueline Ouma, are you there?
Yes.
Explain to us, like 2-year-old babies, how this thing is working, the syndications. Don't mute yourself, just unmute and explain. Say something. What have you understood in all that stories? What is your take home? Jacqueline, don't tell us you have nothing to take home. Do you have something to take home? Now, to simplify, I've said the advantage of this arrangement lies in the limit on personal liability of the syndicator. Yes, Jackie?
You want me to explain about the syndication, Ama, the whole of the things you
No,
said?
just the syndicate. This part, the part of the sharing.
Me, I think syndication is just like licensing for the sharing partners to work. How will I explain it?
Is a formation, it's just a grouping to help them. Now, you see, you cannot go collecting money from individuals, isn't it? It is illegal. So the very reason they are coming together and registering now the syndicate is for the syndicator to be able to get money from the investors. That is one thing, right? But I've said the challenge is coming now if the person who was purporting to have the knowledge of the real estate lacks the knowledge in calculating the IRR at the onset. Because this is the only thing that will make the capital accounts to be negative, isn't it? So when we come now to deducting now all the taxes, and we said one of the advantages that they were taking over in coming together was the tax pass-through. Had they gone as individuals, it would have been very expensive because the taxes are so many. Stamp duties, capital gains tax, name them, they are so huge. So by coming together and operating as a partnership, they are going to enjoy the tax advantage. But if they go wrong, in coming up with the IR figures, then the syndicate will collapse. Tuko pamoja?
So can I ask a question?
Ask.
There's this property, I can't remember the name,
The
it's
first one, Dalak. The first one, or which property? Or
I can't remember the name very well, but it was owned by, I don't know, a certain bank, some kind of bank. I can't remember. So the bank offered some people to buy that Nini land and the particular houses, but later on, after some years, the bank didn't perform their obligation as they had come to a proposition in the earlier year. So now,
what was the mandate of the bank?
The bank was supposed to give them money so that they can. No, the bank was supposed to give them money and allocate the people who are supposed to build those houses. So, but the bank didn't do as they were supposed to do. Then later on, everything fell apart. So the people who trusted in the bank later on came out to complain. So I'm asking, is that a failure of that syndication or what?
Now, was bank merely giving the capital, or they were part and parcel of the syndicate? Were they partners?
It was giving the capital, and also it was part of and parcel of those the syndication, I think.
I don't know the nature of the bank, but you see, banks are not allowed to, invest in real estate. Did you know that? They are commercial banks. Their license is merely receiving the deposits and giving out the credit. Banks are not allowed. The only bank that is allowed to acquire properties in Kenya, we have only one investment and mortgage bank. Yes, it's called HF Group, Housing Finance Group. All the other banks are not allowed. They can only give you credit. They are not supposed to be part and parcel of the syndicate.
Okay.
You see, if my mandate is giving you credit, how you pay it back. The assumption is I had already underwritten your risk, isn't it? So I had done an assessment. You can't hear me?
I'm hearing you.
I'm saying I had already done an assessment and I saw that you qualified. Unless you tell me the bank that you are talking about, they got some information that they didn't have when they were coming into the syndication. So once they got that information and they noticed it will be injurious, they just terminated their engagement, unless you tell me that. Unless you tell me that. Otherwise, banks are not allowed to invest in real estate. They cannot.
I'll check on it, then I'll ask you later.
Okay, kindly check.
Because I can't remember the name right now.
Of the bank. If it is not housing finance,
all over the news.
No, if it is not housing finance, then there is no any other bank that is allowed to be part and parcel of a syndicate. All the other banks are commercial banks. We have only one mortgage bank in Kenya, Housing Finance Group.
Okay. See, yesterday there was a certain bank that was, I don't know whether they launched something. I can't remember.
Which one?
No, I'm not talking to you.
Okay. Very well. There is another person who has asked, between A and B, who has been taken advantage of? Between A and B, who has been taken advantage of? In our example. Whereas the objective of coming together was not to take advantage of each other, but whom do you think has been taken advantage of from the word go? You can see what is happening. This is a scenario. A contributes 100,000. B is a general partner. They don't contribute. So the partnership goes ahead and secures a credit. And this is one time, so we are not going to amortize it. It's only 40,000. Yeah, we are told it's an non-recourse. And then they invested the 500 in an apartment. Once they invested, our scenario one was the tax liability. So we have a tax depreciation of 50,000. And in this tax depreciation, we can see how it's being shared. A is getting 90, B is getting 10. Has anyone been taken advantage of? That was the agreement, isn't it? It is 90-10. It's only that B did not give out anything. So you can see what is happening. The reason why B seem not to be performing so well is because they didn't contribute anything, but they are paying less. I don't know whether I've answered the question. Let me see who this was. Jane Namu, have I answered your question? Have I answered your question?
Yes.
Yeah, so B has not been taken advantage of. The reason why, you see, they didn't give any capital. That's why we are saying the capital accounts is supposed to reflect how these members were contributing. Because it comes a time when it is a loss and they are sharing the loss, the person who didn't contribute capital seem as if they are being disadvantaged. Are we there? We'll be coming to mortgages. You'll see how these things operate in the real environment. Do you have any other concern? I'm winding up this lesson. There's someone who was on notice, yes? We can't hear you. Your network is not stable.
Hi.
In there?
I'm saying on the first case of Dalak.
I go to Dalak.
During the loan amortization.
Let me go back. This is the Dalak's case.
During the loan amortization, we found out that they were paying that 1,000 as interest per month.
Yes, that is not interest. The repayment per month was 31.
The bank.
Yes,
from the amount. I'm saying about the.
Go on.
From that
with your
31, and we found out that the general, now all the partners were 36. Will they share that amount or what? How will that go?
That one will not be shared. I said the challenge with the syndications is debt financing. Ideally, we know, or in many cases, we know that you are supposed to pay equity plus debt, isn't it?
Yeah.
But in a syndication, the syndicator is the one who is taking the mortgage financing of 3 million, right? So they are going out to the investors to borrow 1.18 billion. So the investor is not concerned. You see, we assume that the syndicator is a professional in the real estate industry. Kwa hivyo alifanya mahesabu yake na ameona from the IRR hii hesabu yake itamrudishia income. Are we together?
Yeah.
So ile pesa general partners were not general. Ile pesa the limited partners or the venture capitalists are bringing on board need the remainder. So you see, out of the remainder, the equity needed is 59 million and 1.21 billion. So limited partners are chipping in to merge the difference. So general partner ni yeye amechukua debt na ni yeye atalipa.
Ni atalipa hiyo 31K.
Yes, he's a professional. Now look, ukiangalia some land buying companies, do I have a specific case? Let me give you a specific case. Urithi Housing Cooperative. They are in this business. There were some houses they were constructing in Kenyatta Road. Yes? So they had their capital and they had the money they had borrowed from their financier, their bank, isn't it? Lakini ile pesa haikuwa inatosha a project. So they went to the public and declared that we are coming up with this estate. If you contribute, as at the end of Kenyatta Estate, I don't remember, the names are not coming. Boma Homes, exactly. After we construct and end the Boma Homes, we are going to allocate you your house. That was the arrangement. Are we together? And then from the value of house, you pay us the difference. Tuseme during the formation, ulinipea 3 million. Nyumba ikimalizika, I'm intending to sell at 7.5. So wewe tukimaliza nyumba, utanipea 4.5 tumalizane. Umenielewa?
Yeah.
Kwa hivyo ile loan urithi walikuwa wamechukua, the people who are bringing in the 3 million are not concerned. Urithi wamefanya mahesabu yao na wameona tukimaliza hii project, kila mtu achukue nyumba na 7.5, tutakuwa tumelipa loan na tumepata income. Is that now clear?
Yeah. Now it's clear.
Yeah. So some of these things you have to go to the ground and give the real case examples. Any other concern? My assumption is this is theory. So we have the notes here and we are going to read. But to end it, there's something I needed to, before those two questions came. Now look, we have indicated there that in establishing a limited partnership, great care must be taken. I mean, paragraph 2. Great care must be taken that the contractual terms identify it in effect as a partnership and not an association. This will be the understanding of taxman. Because if it is an association, you will not have gotten the pass-through advantage, the tax pass-through advantage. So an association is taxed like any other corporation. So you have to make sure that the criteria of coming together as a syndicate is followed. And these are the 6 requirements. So you can see you must be a business association. To mean the purpose of coming together is to commingle your funds for you to be able to invest. 2, the objective is to carry on a business and divide the gains therefrom. So lazima mkuwe mmekuja pamoja. You know, this is not a political party. Mmekuja pamoja so that ile faida mutapata you will share. Hauwezi ingia kwa kitu unajua ita make losses. You better even put your money in a fixed deposit account. 3, continuity of life. So you are assuming a going concern. So that if we invest today, 5 years down the line, I won't tell you that the investment collapsed. 4, centralization of management. And this is key when it comes to syndicate. We want this property to be managed at a central position. And this central position is the syndicator. Then 5th, the limited liability. So we know that the general partner or the syndicator has unlimited liability. That's why they can go ahead and borrow. But for the person who is bringing in the equity, they have limited liability. And then the last one is free transferability of interest. We expect that after we sell, we are going to share without any problem. So a corporation must have more corporate than non-corporate characteristics to be classified as corporation for tax purposes. So you should ensure that you are bound by criteria 1 and 2 before you look at the 3 to 6, because this is what will be binding. Are we together? I think that summarizes our classes, because the last part is talking now of the use of now the general partners, use of corporate general partners. And now we know that the sole general partner of a limited partnership is often a corporation in this kind of formation. And the advantage will lie now on the limit of the personal liability, right? Because we know that the limited partners may not own individually or in the aggregate. So we understand that the formation is the corporate general partner is like the one who is running the show. And that's why right there, we are talking about the net worth. If these people don't have any wealth, it will be very hard for them to raise the 20% that is needed. So the net worth requirement of the corporate general partner depends on the total contributed capital in now the syndicate. So if the contributed capital is less than 2.5 million US dollars, so we are talking of 2.5 billion, the corporate general partner must have a net worth of at least 15% of the total partnership capital. Why? We want to make sure that this syndicate will not fall. It is not a scam. So it is a requirement. So where the contributed partnership capital is 2.5 million US dollars or more, the corporate general partner must maintain at all times a net worth of 10% of the partnership capital. The reason why this is maintained is to ensure that the general partner will not take advantage of the individual investors who will come to on board, or to avoid the dummy corporations as the sole corporate general partner. And this is hedged under the safe harbor rules. So we want to know that we are safely harbored in this property. Hakutakuja tu upepo ama mawimbi kidogo kidogo meli ianguke. And that is what is happening in most syndicates in Kenya. Because the formation did not consider the safe harbor, some of them comes as chamas, table banking, then by and by they license themselves as MFI. Before we even recognize, they are already a syndicate. They go down with the members' money. Any question? So I want to end this here. We go to the portal. There is one discussion that you're supposed to, I think you just need to give me the difference between the partnership versus why the different way of taxing the partnership and the corporation, because that is really the advantage that the syndications are taking in forming one. Any question to this end? You can see there is one in the chat room. Syndication failure. Could this be the cause of collapse of Gakuyo real estate owned by David Kariuki Ngari? Yes. David Kariuki Ngari, that was not even a syndicate. Now it's like a pyramid scheme. He's a bishop. He goes to the church, whose members to start giving their money somewhere. And then this money, he goes and purchases parcels of land and make it mandatory that each member must buy a parcel. So can you imagine that? Can you imagine that pyramid scheme? I give you my money. Well, I know the prevailing market price of a plot, let's say, is 500,000. Lakini nikupe pesa yangu, ikifika 500,000, uniambia umeninunulia plot ya 800,000. So you swindle me 300,000, nikiona na macho. So Gakuyo could not be the best example here, Nicholas. That was not even a syndicate. It was not a syndicate. Nicholas.
Yes.
Yeah, Gakuyo was not even a syndicate. That was a pyramid scheme that collapsed.
Oh, thank you, sir.
Yeah, you see, a syndicate, investors give your money with the knowledge that you are qualified in the field, isn't it? And they will get return for their money. But Gakuyo was a bishop. He was not even a realtor.
Okay.
Yeah.
Thank you.
Okay. So in absence of any other question, I want to wish you a good afternoon. But we go on the other side and meet and interact in the portal. Enjoy your afternoon.